We know that Alibaba is a great business, but we have to answer the second question. What material impact will this investigation have on the business model, on its competitive advantage, on its growth projections? So first, let's understand what the government is doing. So the Chinese regulators are looking into Alibaba's practice of pressuring their online merchants into entering forced exclusivity agreements, essentially giving them the option of either listing their products on Alibaba's platform or none at all. So basically, Alibaba's competitors, Pinduoduo and JD.com, are complaining that Alibaba's being a big bully. They're unfair because they're telling their merchants that if you list on competitors' platforms, you can't list on our platform. So either us or them. So this is forcing merchants to choose, and because they're choosing Alibaba, they can't list anywhere else, and this is unfair monopolistic practice. So the government is probably going to go in there and say, you can't do that, it's unfair. You gotta allow your merchants to list on competitors' platform as well. So that's essentially what's happening. So what could be the outcome of this probe, this antitrust violation? So no one knows the outcome, but let's look at three scenarios. And the first scenario would be no impact or minimal impact. So in the first scenario, basically investigations would clear Alibaba of any monopolistic practices, or they may say, okay, yeah, you did violate some of the rules, so you're going to pay a small fine and I'm going to give you a warning, don't do it anymore. So that's the first scenario. So in this first scenario, I don't see any impact to the company's growth rate or its valuation. So in this scenario, it means that Alibaba is still gonna, business as usual, and that means that the share price is gonna be really, really undervalued. It's kind of like 50% undervalued. It's gonna be a great buy. Now, is this possible that they're just gonna get away with a fine? Possibly, and the reason is because this is not the first time they're getting fined. In fact, a couple of months ago, Alibaba and Tencent were fined for antitrust violations. And guess how much the fine was? Alibaba, if you read this article, Alibaba was fined 500,000 Chinese yen. That's only 76,000 US dollars. So it's pittance, it's a joke, right? It's like slap on the wrist. Go, you go, take it and go, right? So that's the first scenario. The second scenario could be a mild impact. So I think this is the more likely scenario, all right? So in this second scenario, I see that, there'll be moderate fines. They'll pay a small fine, and there will be slight changes to the company's business model that will prevent them from forcing these exclusive agreements onto merchants. So because of that, merchants can now list on other platforms as well, JD.com and Pinduoduo. So what would the impact be on Alibaba? Now, first, I don't believe that any merchants would leave Alibaba. No way. Because again, it's a platform that everyone has to be on because it's the monopoly, right? But this would also allow them to list on other platforms. So yes, they could take away some business from Alibaba. But how big is this impact? How many merchants are being forced into this exclusive agreement? Okay. Well, here's a clue. Recently, during a earnings call with analysts, Pinduoduo's management made a statement. They said that prolonged pressure exerted by dominant platforms on merchants to take sides. They're referring to Alibaba, of course, right? For the last 12 months, the pressure on brands and businesses have intensified, and over 1,000 well-known brand flagship stores have been affected on our platform, referring to Pinduoduo, right? With a total number exceeding 10,000. And this, again, is from the call with analysts. So essentially what Pinduoduo is saying is that because of this unfairness, 1,000 brands can't list on our platform of flagship stores, and 10,000 in total. So what do they really mean? Now, remember that Alibaba has two platforms. Well, many, but the main two are Tianmao and Taobao. Now, Tianmao, their merchants include flagship brands like Nike, like Apple, the big brands. They sell their products on Tianmao, right? Now, there are a total of about 250,000 merchants. So what Pinduoduo is saying is that 1,000 of them are being forced into this agreement. Okay, so what is 1,000 out of 250,000? That's less than 1%. That's only like 0.4%. Okay, and they are saying that in total 10,000 merchants are being affected by this forced agreement. And let's assume that this 10,000 refers to Taobao, which are the rest of the merchants, right? So 10,000 divided by 10 million merchants on Taobao is 0.1%. So what I'm saying is that if the government stops this exclusive agreement, how many merchants are affected? The answer would be less than 1% of merchants will be affected. In fact, 0.4%. So it is pretty small. Okay. So how will this affect the company? How will this affect Alibaba? So first of all, I believe that Alibaba's current sales, profits, and cash flow will not be affected. What could be affected could be their growth rate. This may reduce their future growth rate because they lose some business to competitors. Right now, how much would it affect their growth rate? It's really hard to project, but I'm going to make a guess. I'm just going to guess that it's going to affect their growth rate by 20% in this mild scenario. In other words, their growth rate will fall by 20%. So I showed you earlier that their historical growth rate was 27%. Their projected future growth rate is 21%. So what is a 20% drop of 21%? So if you cut off 20%, that brings down their growth rate to 16.8%. So in this second scenario, I'm going to assume that their growth rate will drop from 21% to 16.8%. So write this down somewhere, because later on when I do a valuation into the company's shares, I'm going to use a 16.8% growth rate instead of 21%, which I used previously, all right? Now, of course, there's scenario number 3, which is the nightmare scenario, right? Severe impact. The Chinese government is pissed off. They are saying, okay, we're going to break up the company, like we're going to break up Facebook, we're going to break up Google. They get aggressive, all right? And there are major changes to the company's business model that prevents them, number one, from, of course, these exclusive agreements with other merchants. But at the same time, the government may force Alibaba to divest or to sell off their stakes into their other businesses like cloud computing or Youku, which is the entertainment arm. All right, and they may have strict rules that prevent Alibaba from working with or alongside any of their companies which they hold an investment in, to prevent this cross-selling, to prevent this monopolistic arrangement. Okay, now in this severe scenario, if they lose the cloud business, then their growth rate may drop by half. Now, I don't think it's going to happen, but we always need to assume the worst case scenario, right? So if it drops by half, it means their growth rate will drop from 21% by half to only 10% moving forward. Now, this is very, very unlikely, but I'm going to do a valuation based on this scenario. Okay, so this is what I think. What do some of the Chinese analysts think? So let's take a look at an analyst report that was just released just yesterday, right? And this is from one of the Chinese securities companies. So it says over here that, Alibaba was recently fined 500,000 RMB, which is about 76,000 US dollars, a relatively low fine amount. It says over here, it is possible for further anti-monopoly law investigations for the internet sector to be conducted, resulting in short-term uncertainty across the internet sector. Okay. Likewise, we expect that the fine amount may not be large this time, which aims to remind the company to avoid improper acts in the future and to avoid monopolistic behavior, which is prohibited by relevant anti-monopoly laws. It then goes on to say, our current investment rating for the company is a buy with a target price of 360 Hong Kong dollars. Despite short-term headwinds for the company's share price, we think that the company's fundamentals are solid. Therefore, we maintain our investment rating as a buy. Meanwhile, we believe that the company will adjust its development strategy to align with anti-monopoly laws. our target price represents a 34.8 times 2021 non-GAAP price to earnings ratio. Now, the company is referring to Alibaba, listed on the Hong Kong Exchange, and their target price is 360 Hong Kong dollars. So again, they're referring to the Hong Kong listed share, which is 9988. So if you buy the one in the US, that's under ticker symbol BABA. So how do we translate this target price into the one in the US exchange? Now remember, in the US, one Alibaba share is equivalent to 8 Hong Kong shares. It's got a 1:8 ratio. So you have to take this value 360 multiplied by 8. 360 times 8 will give you 2880 Hong Kong dollars value per share in the US. Now you have to convert it to US dollars. Okay, so $1 US is equivalent to 7.75 Hong Kong dollars. So we take 2880 divided by 7.75, and this translates to a target price of 371 US dollars for the BABA listed shares, right? So essentially the Chinese analysts are putting a price target of 371 US dollars on the BABA shares on the US markets. All right, so I'm now going to calculate what I think is the intrinsic value of the shares of Alibaba based on the 3 scenarios that I talked about. So first of all, how do you value the shares of a business? How do you know what the shares are worth? Remember, a business is a money-making machine. What the machine is worth is based on how much money the machine can generate in the future. So I use what is known as a discounted cash flow method. So I would project all the future cash flow that would be generated from the business in the next 20 years, and I'm going to discount it to present value. And I divide it by the number of shares. That gives me the intrinsic value per share. So I'm going to now go on to my intrinsic value calculator and take a look at the various valuations based on our 3 scenarios. Okay, so scenario number 1, no impact on the growth rate and value of the business. So what's my base case valuation? So over here you can see I've put in all the numbers for Alibaba. The current cash flow from operations, 203 billion renminbi. Now again, all these numbers are in Chinese yuan, so it's in RMB, right? Company has 121 billion in debt and 410 billion in cash. So these are all the numbers in renminbi. Now, what I'm going to adjust would be the growth rate of the company. So the current growth rate of the company will be 21% growth for the next 5 years. And again, that's our base case scenario. For the next 5 years thereafter, we're going to assume the growth rate will drop to 15%. And for the last 10 years, it's going to grow at 7%, which is the GDP growth rate of China plus 1%, which is what I normally use for the last 10 years, okay? So putting in all these numbers, I get an intrinsic value of 2489 renminbi. So you got to convert renminbi to US dollars, and you basically take 2489 divided by 6.54, which is the conversion rate. So that gives me an intrinsic value of $380, which is slightly higher than the Chinese analysts. So remember, the Chinese analysts, their target price was 371. My valuation on a base case scenario is $380. So if that's the case, let's look at what's the upside for the stock, right? So currently the stock is selling at $222. So if it's worth $380, which means let's put in a line over here, $380. There we are, okay? So if there's no impact on the company at all, it's just a small fine, then from 222, we are seeing huge upside all the way to 380. So that's going to be the best case scenario, all right? And let's take a look. What's the upside? 380 minus 222 is 71% upside. So in other words, the current share price is 71% undervalued, which is a steal. It's a steal, right? Now that's scenario number one. But scenario number two would be, again, a mild impact. Remember, in scenario number two, we assume that the growth rate will fall by 20%. So 21% fall by 20% would be about 16.8%. And 15% drop by 20%, that would be 12%. So let's put that second scenario in. We're going to maintain the 7% because that's the lowest growth rate that we should have for any business in China, right? So that brings us to a valuation of $300. Scenario number two. Okay, so in the second scenario, with a fall in the growth rate of 20%, we're looking at a $300 valuation, which is somewhere there. Okay, which in this case, the shares would be 35% undervalued, which is still a pretty good deal. Okay, now what about scenario number three, the worst case scenario? The worst case scenario is their growth rate drops by 50%. So from 21% drops by 50% would be 10.5%. And 15% drops by half would be 7.5%. Okay, so in the worst case scenario, the intrinsic value would be $211, which would be right here, where we are right now. A bit lower, $211. Which interestingly was the exact bottom that was hit on Christmas Eve. Ooh, is that coincidence? Or is that providence? I'm not sure, right? So scenario number one would be shares at a 71% discount. Scenario number two, shares are right now at a 35% discount. And scenario number three, which is the worst case scenario, would be shares are right at the valuation or just about 5% discount. So at current share price level, it looks like a pretty good deal. So from a fundamental valuation perspective, it looks like the current share price right now has already assumed or priced in the worst case scenario. And if it's not the worst case scenario, which I don't think it will be, it means we've got a pretty good upside in the stock price. So I see a 35% to even 70% upside from current levels. But remember, this will not happen overnight. It's not going to take a day, a week, or even a month. It may take several months or even several years for the share price to recover to all-time highs and go a lot higher. So when I make an investment, I always take at least a 3-year to 5-year investment horizon. Like I said, it may recover in just a few weeks or a few months. You never know. But I always take, again, at least a 3 to 5-year investment horizon. Finally, let's do a technical analysis on the chart patterns to see what we can guess from the price action. Now, it's useful to look at past case studies. Like I said, if you look at Facebook's example during the Cambridge Analytica scandal, the price dropped a total of 44% from the high. And after the bottom, it took roughly about 3 months. It took 3 months to recover back to its high from that scandal crash. Now, how about Tencent? Again, a very similar example, government regulation, government ban, and that dropped 48% from the high, and it took roughly 6 months to get back to the high after that crash. So if Alibaba follows that same pattern and it falls, say, 45% from the high, that means that from the high of 317, it could potentially go as low as about 175 right there. So to me, this is kind of like the worst case scenario based on historical chart patterns and case studies. 45% drop from the high. So right now it has dropped 34% so far, and it could drop another 10% based on that pattern. Okay. Now, if you take a look at the weekly charts on Alibaba, let's look at these weekly charts. Do you notice a pattern in historical support? Yeah, you can see that over here, it's a very strong support at this green line, which is the 150-day moving average on weekly candles. And if you look at the green line right now, it is somewhere about 199. All right. So again, right now we're at 222. So I'm not surprised if it still has a bit more downside all the way to 199. Okay, so people ask this question, Adam, so does it mean that I only start buying if it falls to 199? No, in fact, I'm starting to buy right now. By the way, I already have shares of Alibaba. I bought it a long time ago and it's still above my purchase price. And I'm looking to add more shares to my portfolio. So again, would I wait for it to drop to 199 to buy more shares? Now, I could do that, but the problem with doing that is you can't always catch the bottom. It may not drop to 199, okay? It could actually bottom right now and keep going higher. So you can never catch the bottom. So what's really important as an investor is to always buy in tranches or to average in. In other words, for example, if I want to invest $100 into Alibaba shares, for example, $100, I wouldn't buy $100 at one time. I would start with, say, $25 worth of shares right now, for example, and if it falls to, say, $199, I'll buy another $25, for example. And if it falls all the way to $175, which is the worst case scenario on the charts, I'll buy the remaining $50 where I'm all in. So that way you average in your position. And by getting in a bit of shares right now as an investor, if it doesn't go lower, if it rebounds immediately on Monday, at least you have a position in there. So again, you can't always catch the bottom. As long as you buy somewhere near the bottom, it's good enough as an investor. As long as your potential downside is smaller than your potential upside as an investor, that's a pretty reasonable point to add shares. So again, for example, if Alibaba goes down to 199, that would be a potential downside of 10% from current levels. But if Alibaba were to start rebounding back to the intrinsic value of $300, remember that scenario number 2, that would be a 35% upside. So a 10% downside potential to a 35% upside potential. And again, that's scenario number 2. Scenario number 1 would be, of course, the best case scenario, that if Alibaba were not really impacted by the regulations and it goes all the way to 380, and that would be a potential upside of about 71% if I'm not wrong, all right, over 71%, and a 10% potential downside. So again, downside 10%, upside 71%, pretty good deal, okay? Now, again, what I've been looking at so far are the weekly candles. Let me now zoom in down to the daily candles to get a shorter term perspective if, for example, you are going in for a shorter term trade, and let's see what we find. So going to the daily candles, boom, all right, and let's zoom in a bit more and let's expand this chart like so. So what do we see on the daily candles? What we see is that the market on Christmas Eve, it was like a half-day session. It closed with a long lower shadow, creating kind of like a what we call an ice cream bar. Not really a pin bar, but an ice cream bar, which is a potential bullish reversal pattern. But it has to be at a strong level of support. Now, where do I see a level of support on the charts right here and right now? Okay, I see a level of support and resistance somewhere about here. Right there. You can see that this was the previous, let me just get rid of this. Okay. So this was a previous resistance. So again, resistance becomes support once it breaks out. So it broke out with a gap, and that's support over there. So right now you can see this pin bar or this bullish ice cream bar is right below that previous support, and it's now become resistance. Now again, bear in mind, although it's a red candle, it is still considered bullish because of the lower, lower shadow, right? So regardless of the color. So what I need to see is I need to see that for the next few days when the market opens, the price has to close above this line. And this line is roughly about not 3, what am I talking about? It's about $230, okay? So in the next few days, if we get a few bullish candles or even one big bullish candle that closes above $230, that could be a reversal, right? So if I'm taking a short-term trade, I could, for example, enter Alibaba at say 231, 232, for example, and I could place a stop loss. Now remember, in trading, it's a one-night stand, right? So in trading, you want to put a stop loss right below the low of the candle. You can put a stop loss at say about 205. So if we enter at 232, stop loss at 205, what would be our risk per share? 232 minus 205, our risk per share would be $27. All right, so again, in trading, remember that we always risk 1 hour to make more than 1 hour. So we call this our 1 hour or our risk per share. So if we aim for 2 hour times 2, that's $54 profit target above 232. It will give us a profit target of 286. So 286, let's round it off to about 270 over there. So 270 would be our short-term profit target. There you go. So this is if you're going in for a short-term trade. Now for me, I'm not going in as a short-term trade. I'm going in as an investment. So it's different, right? So as an investment, I don't have a stop loss because I know it's a great company. It will go high eventually. It's only a question of time. It'll take 3 to 6 months, maybe longer, but it will go high because it's a great business. So as an investor, no stop loss for me. I'll start adding shares. Right now, I don't have a problem with that. In fact, I'll probably want to see a close above 230, start adding shares. And like I said, it could start rebounding right now, but if it can't close above 230, then we could see, again, more potential downside for the short term, and that's fine as well. Okay, and again, our downside would be either 199, which is this very strong support over there, or worst case scenario, if it drops like Tencent and Facebook in the previous case studies, it could go all the way to 175. That's my worst case scenario on the charts. So this is exactly how I analyze an investment and a trade. I look at both the fundamentals and the technical analysis, and I marry them together with a very, very clear strategy. So again, whether you're entering as an investment or trade, you gotta have a clear strategy. What's your entry strategy? What's your stop loss, if any? For trading, yes. Investment, no stop loss. What's your profit target? What's your potential upside? As long as your downside is lower than your upside, it's a great investment, it's a great trade. And that's how, that's my thought process in the markets. Hope you enjoyed it. Hope you learned something. This is Adam Khoo. May the markets be with you, and have a happy Christmas and a happy New Year coming up. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.